Today, we're talking about index funds and single stocks and which ones might be right for you. Now, if you don't know anything about stocks or index funds, don't worry, because we'll be going over that during this video. This is not financial advice. This is really just for educational purposes, as well as me detailing my experience with my investment journey since I started in 2017. Also, stick around to the end of this if you're interested in seeing some of my favorite index funds that I invest in personally. Also, if you find any value from anything that we go over here today, please do smash the like button and subscribe. It really does help. They're not just making that up when they say that. So if you do that, I'd appreciate it. Now, let's get right into it. Now, it's no secret that investing can be scary, especially for those of us who are millennials or Gen Z. We grew up during the Great Recession of 2008 through 2012. It's really part of our childhood to be afraid of the stock market and Wall Street. And while it's true that stocks do go down and the market does have dips, the overall trend historically has been a positive one. It's been a good one. For example, the S&P 500, which is an index that tracks the market since its creation in 1957, has seen on average, year over year, a little bit over 10% returns, meaning that for every year since 1957, it has returned an average of over 10% to those stocks that are part of that index. But despite the gains, there's always the chance of loss, and we're going to be going over that a little bit here today. Not to mention that, but there's also so many different investments to choose from today. You probably know about stocks or you wouldn't be on this video, but there's also bonds, there's treasuries, there's crypto, there's art, there's real estate, NFTs, tulips, beanie babies, probably for our generation, Lego sets. Really the option is yours. There's a bunch of ways that you can spend your money in an investment strategy. However, I think that for most people, the best way to get started is through the stock market, but more specifically through index funds. But in order to understand index funds, we really need to first understand what stocks are. At the simplest level, a stock is just a piece of equity in a company. So if you were to own one share, that means you own one small piece of the company you purchased. When the value of your stock goes up, if you just purchased that one stock, that means that the company that you purchased the stock from, either they have more valued assets now, so they have a larger accumulation of assets, or perhaps they have better earnings, or they're producing more value for the customers. Alternatively, it's possible that people have simply attributed more value to the company and it doesn't actually have more assets or production in terms of product that is producing. And this can cause the stock price to go up based purely on speculation. This is probably something we'll talk a little bit more about in the future, because that's a general rule. When the value of your stock goes up, that means that the company you purchased is now worth more. Alternatively, the stock you have may go down in value, and this might be the result of the company having worse earnings, meaning they are producing less value for customers, fewer people are purchasing their product. It might mean that they have fewer assets than they once did, and this can drive the price of that stock down because they're no longer as desirable. And in the same way as previously, every once in a while you have a case where the company may not actually be producing worse than it was previously, but it is being speculated to be less valuable in the future. But the important takeaway is that if your stock's value goes down, it means that people are willing to pay less for the stock you purchased. They're willing to give you less money for the amount of that company that you own. So as a general rule, for most people, and the vast majority, if you're buying a stock, you are hoping that the value of it goes up over time. You are expecting that the price you purchase the stock at today is less than it's going to be worth in the future. When we think about this type of investing in single stocks, there are some great benefits or upside. If you consider Microsoft stock, for example, in the early 2000s to now, it's gone up nearly 1,300% in value. That would mean that if you invested $8,000 back in the early 2000s, you would have over $1 million today. Those are extremely outsized, insane returns. However, in the same way, the opposite can happen. So let's consider some companies that have gone down. Maybe Sears, for example. Sears stock at one point was worth a whole lot of money, but today it's practically worthless. So if you'd spent all your money in Sears stock, you would be broke today. Now you might be asking, okay, well, you just told me that the stock market goes up in value over time, but if we're investing in stocks and there's so much risk, is there any way that we can mitigate that? And the answer is yes, we can. And that's through something called an index fund. So when people refer to the stock market, when they say that's had a good day or a bad day, they're not usually referring to single stocks. Rather, they're referring to the market as a whole. And we get those values, those scores for how the market is doing based on indexes. One of the most commonly cited index in terms of getting a snapshot of the entire market is something called the Dow Jones Industrial Average. And this is just a collection of 30 of the top producing companies in America. But there's also some other indexes that are popular, such as the S&P 500, which is the Standard & Poor's 500, which is just 500 of the top companies in the US. There's also the Russell 1000 and the Russell 3000. These are other indexes that are trying to do the same thing, but they're looking at different sectors of the market. Now, along with those indexes, there's something that is called an index fund. These are investments that attempt to track those indexes with as much precision as possible. So if you purchase an index fund, you are purchasing a bunch of those companies that are in that index that is being tracked. Therefore, when the entire index goes up in value, your index fund would go up a correlated amount. And if that index goes down in value, your share would go down in value, a correlated amount. The downside to this investment approach is that you're not really likely to have extreme returns, because those Microsoft corporations that you might own within that basket index are weighted down by companies that don't do as well. However, on the flip side, the benefit is that those companies that do really poorly, those Sears, for example, are mitigated by the Microsofts that you have in that basket. So overall, the average returns are still quite positive. Index funds are probably optimal for the average long-term investor. They're encouraged by very conservative types such as Dave Ramsey, among others, because they favor a long-term investment approach. You're not likely to be trading in a daily basis your index fund. Single stocks have more variation both on a daily basis and a yearly basis. So if you're interested in day trading, you are likely going to be trading stocks, individual stocks, not these index funds. Although for certain people, they do like trading index funds when they purchase them as something called an ETF or exchange traded fund. However, all you need to do if you are purchasing this for a long-term investment is that you can do this through investing what's called a mutual fund or buying exchange traded funds. Mutual funds are essentially an investment approach where you put your money into a pool and somebody at a financial institution actively manages those funds to track the indexes that we talked about before. However, there's also the option of buying index funds in the form of ETFs, and these allow you to buy and sell the index fund like a regular stock on the stock market. Mutual funds, you can't do that. It doesn't track the market exactly, and the prices close at the end of the day. So if you're interested in having a little bit more control, you might want to look at ETFs as opposed to mutual funds. But again, if you are a long-term investor, mutual funds are very good, and I personally like both mutual funds and index funds for my investment purposes. A few examples of the index funds that I like to invest in. I do a lot of my investing through Vanguard, so you're going to see a bunch of the index fund ETFs are managed by Vanguard. One of my favorites is one called VOOG, and these names stand for the ticker symbol. That is the symbol that you can look up that represents the stock name or the index fund named. So it is VOOG, VOOG, and it tracks the S&P 500 growth companies. So it's looking at those companies in the S&P 500 that are expected to grow most aggressively over the near future. Another one that I like is one called VONG. That's VONG. It's another Vanguard index fund. And this one tracks the Russell 1000. It's what's called mid and large cap companies. So these are some of the very large and moderately large companies within the United States. One of the most popular Vanguard index funds is one called VOO. That's VOO. And VOO is a mixture of large cap growth and value stocks. Now, if you don't know the difference between the growth and value stocks, that's okay. We can talk about that one more in another video also. However, definitely the most popular ETF index fund is going to be one called SPY, SPY. This one has been around since the 90s, and it is very similar to VOO in several ways. And because of the massive trade volume, since it is the most popular and so many people use it, it's one that a lot of people who are into options trading utilize, but that is definitely a topic for another day. It's a much more complex topic than just basic investing. So that is a broad overview of stocks and index funds and what makes them the same and different from each other. Even sitting here now, I know that this can probably sound pretty intimidating and scary. It doesn't have to be. The truth is that with a lot of these index funds, An approach that I've used and many others have found success with is simply purchasing the index fund, holding it for many years, and slowly seeing those returns. I personally invested in some of these index funds pretty heavily right at the peak in 2021 before we had all of the economic issues that faced the country and the world recently. But I can say that they have since bounced back. So although I might have been tempted to panic sell, I am very glad that I didn't. And before you invest anything, definitely make sure you're not going to be somebody who buys at the top, sells at the bottom. That's the best way to lose all your money. And remember that although the stock market does go down, and there are times when it does not perform well, over time, it has always produced upward trends. Personally, what I did is I began investing with a very small amount of money. I kind of viewed it as fun money. So even if something terrible happened to it, it wouldn't really hurt me. Never invest anything that you cannot afford to lose, but at the same time, make sure that you have an emergency fund and something to fall back onto. But if you are interested in beginning your investment journey, this is how I did it, and I'm glad that I did it this way. It is also worth mentioning that despite the fact that many of the index funds I showed you were created by Vanguard, all of these index funds can be bought and sold on whatever exchange you choose to use. And maybe we can do another video on the different institutions that offer trading services. Again, I use mostly Vanguard, but you can use whoever you would like to. If you got any value from this, I would kindly request that you demolish the like button or maybe give it a small pat on the head, whichever's more your style. Either way, it helps if you do that, and I appreciate it. But hope you have a good one.